Confused about your first loan payment in QuickBooks? Are you staring at that loan document, feeling a knot in your stomach because you have no idea how to correctly record that first payment in QuickBooks? You're not alone. Handling debt payments, especially the very first one, can feel tricky because it's not just one transaction. It's usually split into multiple parts: principal, interest, and sometimes escrow. Getting this right from the start is absolutely crucial for accurate financial statements and taxes. Many small business owners make the mistake of just categorizing the entire payment as loan expense or interest expense, which completely messes up the balance sheet and overstates expenses. You need a system that properly separates the principal, which reduces your liability, from the interest, which is your actual expense. Today, we're going to break down the process step by step. We'll assume you've already set up the original loan liability on your balance sheet in QuickBooks, whether it's an initial entry or it was created through a prior journal entry. If you haven't done that, pause this, set up a long-term liability account or short-term, depending on the loan, and come right back. Memo: the three-step process to record your payment. Here is the most accurate and common way to record your payment using the expense or check function in QuickBooks. 1. Start the transaction. Go to your bank feed and click on the transaction for the loan payment, or go to the plus symbol, new button, and select expense or check. This is the easiest method because it lets you split the total payment into different accounts. In the payee field, select the bank or financial institution that holds the loan. In the payment account field, choose the bank account from which the money was withdrawn. Enter the total payment amount in the main dollar field. 2. Split the payment. Now we need to correctly allocate the funds in the category details section. This is where you look at your loan statement or amortization schedule to find the precise breakdown of your payment. Let's imagine your total payment is $1, $500. Line 1, interest expense. You'll select your interest expense account, which should be an expense type account. On this line, you'll enter the dollar amount that went towards interest. Let's say it's $1,000. This amount immediately impacts your profit and loss statement. Line 2, principal reduction. You will select the long-term liability account you set up for the loan. This is the crucial step. On this line, you enter the dollar amount that reduced the principal balance of the loan. In our example, that would be the remaining $500, since $1, $500 $1,000 equals $500. This action reduces the liability on your balance sheet, moving you closer to paying off the debt. Pro tip: if your loan includes an escrow component, like for property taxes or insurance, you'd add a third line here, categorizing that portion to an other current asset account called escrow funds. 3. Review and save. Once you've entered the separate amounts for interest expense and the loan liability, double-check that the sum of the lines equals the total payment amount at the top. The transaction should look clean and balanced. Now you can click Save and Close. White heavy check mark why this matters. By following this method, you ensure your profit and loss statement accurately reflects your actual interest expense for the period, and your balance sheet correctly shows the reduction in your outstanding debt. This is essential for communicating your true financial position to partners, banks, and especially tax authorities. You'll now see the loan balance decrease by exactly the principal amount you recorded. With that said, thanks for watching, and until next time.